category is routine execution. Given what you set out to do, how well did you actually execute it? Did you land the triple backflip, or did you stumble on the landing? And the final one is general effects. So this is for your presentation. Applicability to the theme is a big one here. So for this event, it would be sovereignty, and then maybe how creative or extra pizzazz you added to your project.
Cool. Let's move on to our honorable mentions winning Bitcoin++ tickets.
Yes.
Our first honorable mention goes to
Golden Goose.
Yeah, for our honorable mentions and overall top picks, we also have a special little prize, some chocolates or truffles from a local chocolate shop.
Yeah, thank you.
Congratulations.
Thanks. Yeah. I think, cool. Next up, we have Your Space V2. Congrats. I'm going to mess this up. That's okay. Hey, congratulations. Yeah, thanks.
Our next honorable mention goes to
BitLearn. Cool. Congratulations. Yeah. Thanks. Cool.
Our next honorable mention goes to
Bunch. Okay, cool. There's 3 more. Cool. Congratulations. Yeah, thank you. Next.
Our 5th honorable mention goes to Tui Mint.
Cool. All right. Congrats, Connor. Good job. Yeah.
Good job, Connor.
Sorry.
And our last honorable mention goes to
Bitcoin sovereignty, also known as Line Pay. Yeah, congratulations, guys. I have one of these. So yeah, congrats.
Congratulations.
Oh, thank you. Nicely done. Yeah. I guess I'll take a picture. Nope.
Cheers,
okay.
guys.
Great. Good job, guys.
So much for pictures. Yeah.
Like, totally messed.
All right.
All right, so as you notice, we have 3 bags left. So we have a first, second, and third to go out. This would be our best overall.
Yeah, this is for all the marbles. So we have a lot of sats to give away. Our top 3 prizes overall are getting 3 million sats, 2 million sats, and 1 million sats, plus Bitcoin++ tickets, respectively. So in addition, this is also for the title of the overall victor of Bitcoin++ Taiwan. So a lot to give away. In third place, can we get a drum roll, please? But first, let's have a few announcements.
All right, everyone. Thank you so much for coming to Bitcoin++ Sovereignty Edition. I want to take a moment to thank our sponsors. Oh, I did not update that. This is a Sovereignty Edition. Big thank you to NYDIG, who made this entire year of 6 events across 6 countries, completely possible, along with the Human Rights Foundation. These events would not be possible without the generous support of sponsors like these 2. So if you're looking to get back to the Bitcoin developer community or really help advance the cutting edge of Bitcoin, we'd love to have some sponsors. Also for this event, we had Stacks sponsoring our workshop stage, so big thank you to Stackworks. Quick plug for the Bitcoin++ Insider Edition over at insider.btcpp.dev. This is where we're writing up what's happening in Bitcoin outside of our conferences. So if you're looking for a insider look into what's happening in Bitcoin, check out Insider Edition. Also want to give a big thank you to the Taiwan Bit Devs. Thank you for, we can't make these events happen without local support and connections, so thank you for being our conduit into Taiwan Bitcoin ecosystem. It's been a busy year for us. I think we have successfully completed all of the missions. We've got 6 events across 6 countries. This is our 13th ever Bitcoin++. So thank you for coming and making it a huge success. But there's more coming for 2026. So check out some of the events that we have planned all over the globe. Particularly want to highlight our upcoming Privacy Edition in Seoul, South Korea, which will be at the beginning of November next year. You can find this event plus others. Well, I don't know if this one's up there yet. It will be soon. I'm sending out an email when it's available, or pay attention in the Telegram chat. And you can always find all of the events that we've got coming up for the next year on our website at btc++.dev. What else have I got in here? Oh, okay. So without
where were
further ado,
we?
oh yeah.
Completely forgot what was going on.
Back to the stuff. Cool. Third place. Winning 1 million Satoshis and tickets to a Bitcoin++ conference next year is Functional Bitcoin Block Validation Binary. Yeah.
Great. Congratulations.
Cool.
Yeah.
Nicely done.
The silver medal, winning 2 million sats plus Bitcoin++ tickets in 2026, goes to
Me. Great, cool. We were particularly impressed at the sovereignty aspect of this one, so congratulations, yeah. Nicely done, me. And last, but certainly not least, best overall, winning 3 million Satoshis, tickets to a Bitcoin++ event next year.
And the title of overall winner of Bitcoin++ Taiwan
Sovereignty Edition goes to
Frostdow.
I don't think it's here currently. We'll make sure that they get the chocolates and their award. Is that it, Alex?
Yeah, I think that's it.
All right.
Actually, for all winners, we're going to, for all winners, can you come up here? I need to give you a link because we have an intake form so we can get you all paid. So if you want a prize right after we close, come to the stage and we will distribute your intake forms. Cool. Thanks to everybody. This was an amazing hackathon. Super honored to be here with all of you today.
And thank you for coming to Bitcoin++ Sovereignty Edition. Oh, there's a party tonight at Tempa House at 7 p.m. Please register, but even if you haven't registered, we'd love to see you there. Just wear your name tag, and we'll make sure that you get in. So thank you for everyone for coming, and can't wait to see you in 2026.
Thank you for the team.
Thank you.
Okay, hey guys, yeah, I think you guys can hear me all right. Thanks for coming for this talk. It's for me, it's going to be one very interesting, a lot of feedback I'm expecting later on when I talk to my fellow colleagues. And I think it will be very different from the other, talks that you hear. And I wanted to make sure that, I've been building in this space for a long time, like for the last 7 years, mostly on self-custodial tools and Bitcoin on-chain and Lightning tools. And I wanted to share my experience and, where we have come to this stage and why we are coming to this stage at the journey of our development. One very important thing for us to understand is like, okay, the theme is sovereignty, but you just can't equate sovereignty to self-custody. Self-custody is great, that's one thing. Sovereignty is something very different, and that's what is also very important for devs building in this space. And I know this place is full of developers and budding people who are going to code amazing tools in the future, right? So hopefully this sets some perspective when you guys go ahead and build your amazing stuff. When we talk about self-custody, the consensus definition is if you have unilateral exit, that's great. That's called self-custody. But it's not just unilateral exit. What about continuous use? So when you are able to permissionally use a tool, that is when the tool is really sovereign, right? That's essentially how you can differentiate between a sovereign tool and a self-custody setup. So that's why permissionless continuity of using a tool is way more important than being able to exit. Yes, you can exit, but one, you might not be able to use your keys outside in the same way, and you might be stuck with that walled garden because of the data or the infrastructure or a lot of other stuff. So that's what I'm trying to focus here. My name is Anant, and I'm not really I'm really a technologist, but not a developer. I've worked with code all my life, but what I bring to the table is the focus around all the other aspects of the code, right? When the code is built, in your developer environment, that's great. But when we bring it to real life and people start using it, how does that work? What are the different pressures there? And this is especially for people who are listening to me on the video as well, that you have to understand that your code doesn't live in a vacuum. There are, if you are putting it out there, you are probably putting it out as a part of a jurisdiction. You're putting it out within the expectations of the users that you have built it. And there are a lot of company pressures and stakeholders pressures of how your company starts behaving, which may not be directly aligned with the tool. So that's what we are going to look at here. But it's very important to understand that there are a lot of forces, or vectors working around the code that we build. So that's essentially where I come in. Like I said, my name is Anant. Our main company is based out of London, and the reason I'm highlighting that is because UK is one of the areas which is very hands-on when it comes to the regulatory stuff, and we have had to discuss a lot of stuff with regulators throughout the years. So we have had actual interactions with lawyers and regulators and people building in this space in UK and who have moved outside of UK for certain reasons and so on. So UK is further ahead down the curve when it comes to regulations. Hopefully other countries don't catch up, but this is a good example for you guys to understand what regulations can get you to do which you might not really want to do. Okay, so that's where I come in. Like I was saying, sovereignty is not really self-custody. They're two different things. Self-custody is about who can move the funds, who can unilaterally exit it. It's more about the users. So if I have the keys, I can, I have the control. No one else has the control. I can move it out. But what it doesn't solve is the software itself, the control over the software. And I have examples of showing that how these two are slightly different in, not slightly different, very different. They're a category mismatch in the sense self-custody is more about your keys and your coins, and sovereignty is more about the tool. So it's more focused on the developer, how long their tool can last without them or with them or without the structure in place or without the devs being there. And it becomes very important when you are dealing with generational wealth, because you don't want your tool to last for a few years, right? You want your tool to last as much as possible. Even, maybe if you have stopped working or someone else takes over, it should still be working. And, Bitcoin Core is one example where it is quite sovereign in the sense that even the initial maintainers, even the initial developers who have went away, it has managed to survive, and we know that it's hopefully going to survive for very long. There are many such examples, Linux and others. So this is basically the difference. Self-custody is not the be-all and end-all. When I started building products, self-custody was like the go-to place where we want to reach, but that's not really all. There are stuff around it which is very important to you, which you learn while you are building through this journey. But so where do things start breaking? Self-custody is great. You have funds. You have control over your funds as a user, but it really starts breaking due to like the other legal pressure, infrastructure dependencies. You might have infrastructure or node that you have connected from someone else. There are governance bottlenecks that okay, you want to build something, but if the governance is not very clear, then you might not be able to maintain the product the way you want it. There are obviously incentive conflicts. You might want to have a feature which is amazing for your users, but might not really be something either your developers want or the shareholders want, because they want to see the company progressing in a certain way, right? So there are all kinds of conflicts. There are users and developers and people who have invested in the tool and so on and so forth. And features can be removed, right? Features can specifically get removed or diluted. So if you as a user are depending on that feature, then it becomes really hard. So things can break down even beyond self-custody. And the features, the failures don't touch the keys. That's great. But the tool, what about the tool? The tool might stop working. You can take the key, like I said, you can take the keys outside, but if all the tools are not sovereign and they start breaking, where are you going to take your keys, right? So this is where things might start breaking down. Why does the distinction matter? Distinction really matters for the developers, for us, who are building the tools. Features which get removed, engineering pressure, forking becomes not possible, even if you are a FOSS license holder, because there might be an infrastructure dependency, or there may be user data. So even if you fork the code, you might not be able to run it. So it is not just the MIT license, it's like a way beyond that. So you have to think about, if you really want your tool to last, you have to think about all these aspects beyond open sourcing it. By the way, the tool that I'm going to talk about, Bitcoin Keeper, is probably, it's fully open source, and it's probably the only mobile tool which a lot of people have actually copied and forked, and actually they're playing around with it. So that's another source where we've got a lot of input from people who are trying it out in their own company or their own community and so on. So this is why we have gathered input from different jurisdictions, not just our own. Self-custody protects you today, but sovereignty makes sure that the tool keeps on going. And if you really want to just map it out, like you can just like a mental map of things. Sovereignty and self-custody, they are things which are neither self-custody nor sovereign. Then there are tools which are self-custody, but they're not really sovereign. And all the four aspects. What you really want is for you to be able to get your tool to self-custody. That's like very important for the users, but also make it sovereign. So we want to move towards the fourth quadrant basically. That's like the end state. And obviously we have examples everywhere. But I'll start off with basically one of the things that we have built. So Hexa wallet, we built this wallet probably 7 years back. We have phased it off, but we learned a lot, and there were thousands of people using this wallet. So Hexa wallet was really ahead of its times, at least 6 years back, and it had Shamir secret sharing. So the way it used to work is you have your private key, but you can shard off that private key into 3 parts or 5 parts or however much you want into an M of N, Shamir secret sharing scheme, and you can share the parts with your friends, your family. You can keep it separately, so you can geographically distribute it. It was a pretty cool product. It used to work very smoothly. People who use it used to really continue to use it, love it, and you used to store quite a good amount of wealth there as well. We know this anecdotally, obviously. But so what happened? So users were able to hold their keys because they had the shards. So you can technically say, yeah, it was self-custody. It was completely a self-custody, and exit was anytime possible, theoretically. But actually the tool, if you really look at it, the shards that you have, you have to bring it to this particular tool to make it back to a private key, right? And then use your funds. So technically you do have the keys, but you would have to really do a lot of work outside to be able to, get hold of your private keys if you're not using the software. There were, open source software outside of the company which existed where you can reassemble the shards into a private key and all that, but it was quite difficult, and it was not really fair of anyone building to expect the users to actually do that. So this is one example which we learned slowly, that it is completely self-custody, but it's not necessarily sovereign. The users might not be able to use their keys even if they have, outside the system. There are other products also. For example, BitKey today. BitKey is self-custody, and they say you have the keys and all, but you cannot use those keys outside the system. So that's really one example which clearly differentiates that self-custody is not necessarily sovereign use of a tool or sovereign use of your funds continuously. And this was one of the first lessons we learned. We went on to make sure that we phase it off properly into a different tool, and funds that people have are safe and all that. But yeah, very, very important lesson we learned. And why do some of these problems start coming up is, one fundamental thing we have to understand is that companies by definition are structures of the regulatory framework. A company doesn't exist naturally, right? Individuals exist naturally, but companies don't exist naturally. When you form a company, you're actually getting into an agreement with the legal framework or the government or the jurisdiction of that space, that okay, this is the company I'm forming, this is what liability it will have, this is what it will do, this is what it will not do, and so on. So by definition, company is a regulatory construct. And when an entity is a regulatory construct, obviously the regulatory pressures that it can have is way more than a natural entity can have. Natural entity can also be pressurized with threat of violence and all that, but essentially it is way less than a legal structure, which should be obvious. So companies are one end of the spectrum, and then individuals are the other end of the spectrum. And what adds to it is most of the companies, or basically the companies, are profit motivated. So that's another vector where the law very clearly states in a lot of jurisdictions that if you are building a company and you are actually getting profits or some kind of incentives from the work you do, then the set of rules that apply to you can be much stricter. So if you have a non-profit company, that's slightly less, that would be slightly less under pressure, and it moves to the other end of the spectrum where there's an individual who is a natural entity, and there are very few pressures the government can apply on individuals. So that's essentially the aspect of companies where you have profit motives, you have regulatory pressures, you have people who are involved, and so on. So these are the two different things. Tool obviously is a completely different thing. It's not really the company. So it has different objectives, different intentions, and the company might be slightly doing its own thing. So that's very important to understand. When we start building, we don't really think about the company as a legal construct, and it will be under legal observation. So another very important feature that we had implemented, in fact, we were the first one who were able to implement collaborative spending with Whirlpool on iOS and Android, and it was a great feature. It was a great privacy improvement over how you manage your own funds. Though we were obviously not running the coordinator or anything like that, but still implementing this feature while it was live for say 6 to 9 months, we spoke to a lot of people who were involved, the users, the investors, and the financial authorities, and a lot of other people. And financial authorities is not just one; they have multiple branches as well. And what we realized is that this is when we started realizing that it is much bigger than what you want to do for the users. That's not really everything. Eventually, we did take out the feature, but the way again we did it is that we made sure that no one is stuck. There is an exit route and all that. But this is another example of how something you want to do as a developer might be very different from what you are allowed to do as a part of the company. So that's another learning we had in our journey. Like it says, a feature inherits the forces beyond the tool's intent, right? Because it's a part of a structure. So that's that. So going away from, like I was saying, company-led versus community-led. So you can again take the example of Bitcoin Core, but essentially it is not really, you can't say that it's 100% sovereign, but it is way more sovereign than a company or an institution-led project, and especially one that is for profit versus this is not for profit. So in a community-led, entities are individuals, they are fragmented forces, they might not even be in one jurisdiction. There is no, and it is both non-custodial, so you're not really controlling funds, no dev is controlling funds. So there is a community-led way of working for tools, which is like there is a precedent in this space. So we can see how that goes, and the forces and what you might want to do might be much more sustainable as a community-led versus as a company-led. So I'm not saying that everything should be community-led, but you have to really think about what you're building, how long you want it to last, what is really you are getting out of it, and the risk you are getting exposed to, right? And especially if you're living in Europe, you see these things very often with your fellow builders either changing their work or stopping or completely becoming a custodial service. So yeah, these are really the two ends. So community-led is obviously fewer choke points, fewer control points, more resilient and more sovereign. And your tool might just be more suitable for that kind of a space. Right. I think I have a couple of slides more, but I should be good for time. Right. So what are we doing? So let's quickly touch upon what we are doing for Bitcoin Keeper. For Bitcoin Keeper, we are moving from really the quadrant 2 to quadrant 4. So we are moving it away from a company-led tool and transitioning into a community-led tool. What that means is it is not profit-driven anymore. It will be, all features will be free in the app, so you can just use it the way you want it. Everything from multisig to miniscript to time lock to the policy keys, everything is going to be free. And there's a tipping option within the app, and tipping and donations have really low regulatory burden. So what we've decided to do is go down that route, and if users use it and love it, they should be able, they might just show their love sending us some sats or sending the developers sats, the people who are building it. So that's what's going to happen with Signal is another example. Signal, you don't really pay a Signal, but and they don't really monetize you by advertisements either, but you have an option to donate within Signal. So we have looked around how a lot of companies or a lot of products work, and we have tried to come up with what is the best suitable for a tool which we want it. It should last generations, because it is for generational wealth, not just like the 5 years and 10 years the company is going to be able to make profit out of it. So this really means that even if we are not really there in 5 years time, this tool has more chances of running than it would be with us in control. The language we have used in the app and on the website, we have specifically looked at it and changed it, because in the if you have seen the latest, what's happening is basically, even if you talk about self-custody or multisig or something like that, some jurisdictions might see it as encouraging buying cryptocurrency, right? And you might be seen as a facilitator. So a lot of companies have actually stopped advertising in the UK. Even educational content they have stopped. So the language is also very important. At any point of time, we don't want to be seen as a facilitator of any kind. It's not very difficult to change the language that you're using in your product, but it is very important that that you're aware of it and you make that change. So that's another thing you would see. So yeah, the tool is going to be built for permissionless use, and someone can keep managing it for decades and decades, even if we are not. So continuity is a main thing. So what you really want to ask yourself as a developer when you're building tools, how long do you want this tool to last? Obviously, the tool's functionality and what you want to do is primary, but beyond that, when it comes to, it's one of the non-functional requirements would be how long you want it to last. Where you want it to be used across the world, okay, then you're really talking about your company being present in all those jurisdictions and, trying to go by the rules of those places, which is less so when it is more of a community-led thing. What happens when the incentives change, right? So if the incentives are going to be community-led and it is just going to be providing the best tool, that's very different from a profit incentive. Can it be maintained without permission? Can someone just open a PR and just make those changes or upgrade your package? Is it possible? Do you want it to be possible? Can someone else pick it up and run? Is that what you want with your tool? What happens when the company or the institution behind it goes? Will it still work in decades from now? So you might want to ask these questions beyond the primary function of the tool, especially when you want it to last for way longer and want it to get used everywhere in this world. So I hope that some of the stuff that we have learned is kind of communicated, and you guys can decide how to use that information. Ask questions, hit me up later if you want. But yeah, there's a lot beyond just building a tool. That's essentially my talk. And we have a few minutes for question and answer, I think. So yeah, if anyone has any questions, I'm happy to answer.
Do you have any examples of what is kind of like a quadrant 3?
Quadrant 3, yeah. So basically, you're talking about, you mean self-sovereign and not custody? So there are a lot of tools which are not really great at custody, or they don't even provide custody. You might say that Bitcoin Core is an example. It has a wallet, but it's not really a wallet a lot of people use. So these are examples where it is a tool that can keep getting used, but it doesn't really provide good custody. Or they might deprecate custody, or no one uses it for custody, essentially.
Any other questions?
Hi.
Hey.
So you recommended community-led as a more self-sovereign model for a project.
It really depends on your tool, but wallets are a difficult space, right? Wallets in business, from a business point of view, is a very difficult space, and a lot of people have learned that. So when we looked at our tool and how people are using it across the world and different jurisdictions and where the arc of regulatory pressures are going, we decided that probably this is a much better approach than it being a community. So it doesn't necessarily apply, it doesn't have to apply for everything.
So my question is that how does a community member support themselves? I mean, after all, in meat space, I have to buy food, I have to pay rent.
Yeah.
And so far, like open source is a much older phenomena than Bitcoin. And some of the most crucial open source projects are under-maintained, understaffed because they are community-led. So it's definitely a model that does not work always. Right?
Yeah, it definitely.
There are only few examples where success has happened.
Absolutely. So the stage we are in is that the platform or the app is very feature-rich. So it is like way beyond in terms of the features that even most of our advanced users use. So we see it as a tool which doesn't need active development for years, but it needs active maintenance. And we are hoping that with the tips and the donation, we should be able to sustain it for longer, because it doesn't really need a lot of work. It's not really driven by, okay, we have to get more users, we have to get more subscriptions and so on. So we are not going to go after features, we are going to make it steady, stable, and we will see how it goes from there. Yeah, but it doesn't have to work for every tool. Sustainability through a company might be bigger, but may not be longer, because it's within the life of the company. And sustainability without a company might be way more difficult, but there are a few examples, like you said, where it works. So it really depends.
Are there other models besides community-led?
So we did explore that like through the years. So should we become a non-profit? Should we become a foundation? Should we do this, that? But what we realized is that if we really want to make the change, and we want to be as away from all kinds of pressures, the easiest is individual-led or individuals-led. So we have come to the conclusion, hopefully, which is good for the project, that it is best to run as independent individuals rather than any organization as such. Hopefully, if nothing else, hopefully this will serve as a case for all of you to see how it goes. Was it really sustainable in a couple of years of time? Was it really maintained or not? But we think this is the best approach for us.
Sorry, I just added one more.
Sure.
Would you say that there was like a specific point where you guys decided to switch models, or is it just like a slow process of realizing?
It was a slow process, but at the same time, if you saw in the last couple of months, maybe 3 months back or 2 months back, the FCA, or the regulatory authority, Financial Conduct Authority of UK, came up with rules where they were seeing a lot of people as facilitators. So if you would have noted, I think Ledger or Trezor actually stopped talking about multisig in UK. So they stopped even their educational pages, right? That would be, I would say, was the straw that broke the camel's back. But we have felt those pressures across, and we have somehow managed it and worked around it. But this was like, okay, you know what? It's a tough ask anyway. We don't want our devs or any of the people involved to be under unnecessary pressure. We have seen how the latest cases went, even though they were not really custody cases, right? So we decided it's just not worth the risk.
Okay, that's all the time we have. Thanks so much.
Thank you.
Hello, everybody. Thank you for coming today. Thank you to Lisa and all the crew for organizing this wonderful event here in Taipei. My name is Tony Clausing, and I'm here to talk to you today about my project called Stable Channels. And Stable Channels is a way to provide stabilized Bitcoin balances in dollar terms while preserving the Bitcoin ethos of self-custody and decentralization. I'd like to start today with a simple chart. This shows the growth of stablecoins since Tether began in 2014. And as you can see, in the past several years, the growth has been exponential. No matter what your thoughts on stablecoins, who can deny the tremendous product market fit that stablecoins have found in the digital assets ecosystem? Stablecoins provide folks and countries around the world access to a stable store of value, a digital dollar bank account, a base pair for cryptocurrency trading, and also a medium of exchange. However, we're here at BTC++, Bitcoin++, not stablecoin++. So my question is, can we offer a stablecoin-like service on Bitcoin while preserving Bitcoin's ethos of self-custody and decentralization? I think we can with something I'm calling stable channels. I'd like to start with a little bit of an assessment of the principal agent problems as they relate to stablecoins and stable channels. And so with stablecoins, we're going to ask the question, who has the user's keys and who has the ultimate value? With stablecoins here, the user has some keys and the user can do some self-custodial transfers on secondary markets with stablecoins without having an intermediary involved. But the issuer, like Tether, also has keys and has capabilities to freeze or seize those assets from the user. And where's the ultimate money? The ultimate money is most likely in US Treasury bonds that are custodied at a bank, and maybe there's also some other types of securities or assets that are serving as the backing of that fiat IOU token. So what's the risk model? Well, with stablecoins, there's a custodial risk. There's age-old bank risk of runs on banks and balance sheet risk that banks need to maintain a one-for-one backing with the dollars. In contrast, stable channels uses regular Lightning channels. The user has their own keys. The user has their own money. It's all Bitcoin under the hood. There's no tokens, there's no fiat, there's no banks involved with stable channels. And the risk model is a self-custodial Lightning risk model, which is essentially a 2 of 2 multi-sig with unilateral exit. So just in this past year, we've seen Wall Street giants explore stablecoins. We've seen fintech giants like Stripe create new blockchains specifically for stablecoins. Circle launching blockchains for stablecoins. Another blockchain ICOing specifically for stablecoins. Tether launching another blockchain for stablecoins, and another stablecoin launching. This is all in contrast with Bitcoin, which is one network, one blockchain. So my question is, when it comes to sovereignty and stablecoins, with all of this proliferation of stablecoins, are we creating new walled gardens? Or are we creating what I think a lot of us are here to build, which is free, open, unfettered, permissionless, open internet money? So with stable channels, we're trying to preserve this Bitcoin ethos, and this is how it works. Stable channels has a pretty simple stability mechanism. What we do is we match up 2 Bitcoin holders on a Lightning channel to stabilize Bitcoin at a US dollar price. On one side is a user who wants stable dollar exposure, the stable receiver. This user is running a Lightning node. This user is also running the stable channel software, which runs beside the Lightning node. The stable channel software matches this user who wants stable dollar exposure with another user who essentially wants extra Bitcoin volatility and is willing to provide that stability to the other user. We match these two types of users up on a Lightning channel, on a regular Lightning channel, and we settle very frequently to maintain the peg at a price. So let's take a simple example. Let's say you're a hodler, you have 1 Bitcoin, and then the price of Bitcoin reaches $100,000, and you think, I like this price, I want to lock it in. One way, obviously, that you could do that is you could sell your Bitcoin for a stable coin, you could sell it on Coinbase. Another way to do that is to download the stable channel's wallet, essentially send yourself Bitcoin into the stable channel's wallet, and if you put 1 Bitcoin into the stable channel, then the stability receiver over-collateralizes that stability position by 1 Bitcoin as well. Both of these actors put in 1 Bitcoin, and then what happens is, very frequently, every 30 seconds, each side goes out and gets the latest Bitcoin price from exchanges. Right now we use 5 different price feeds from different exchanges, Coinbase, Binance, etc., and we take the median. And one of 3 things has happened. Perhaps the price has not changed at all. In that case, the user has 1 Bitcoin and the price is still $100,000, so no payment is needed. Now, let's say that the price has gone down. If the price has gone down, then that means that it takes more Bitcoin to keep this guy stable at $100,000, right? So the stability receiver streams the Lightning payment over to the stability receiver on that side. Now let's take the third example, which of course is that the price of Bitcoin goes up. If the price of Bitcoin goes up, then it takes less Bitcoin to keep this user stable at $100,000, and so this guy's streaming a payment to the stability provider. This guy's effectively getting leverage long position. As the price goes up, he benefits from the Bitcoin that he started with, but he's also getting more Bitcoin from the user who wanted to sacrifice that Bitcoin volatility in exchange for the stability. So, what have I built? I have built a mechanism for a self-custodial user to access this protocol cleanly via a desktop application or a server application. I've also built a Lightning service provider technology stack that lets Lightning service providers provide this stability to users and to manage this and to manage the stability channels that they have with users and to facilitate onboarding to the stable channels wallet, which I'll demo a little bit later. This type of design is only possible because of the instantaneous settlement capabilities of Lightning and the essentially free payments that Lightning enables. What we've built here is only possible because of Lightning, and I want to ask this question to the audience. When it comes to financial relationships, what happens when we can shrink the time value of your counterparty risk to mere seconds? What I think it means is that it opens up a number of different product use cases that have not been explored yet in the Bitcoin ecosystem or in finance. Stable channels is streaming finance. And so what does this enable? What you see here on the left is the Stable Channels desktop application. One use case, which I've mentioned, of course, is stability as a service, which has tremendous product market fit. Another use case is trading within this stable channel arrangement. And so, whereas formerly a user may have wanted only $100,000 price exposure and 0 Bitcoin native price exposure, The user can send a message to the service provider that says, I would like to make a trade. I would like to purchase Bitcoin. So now recharacterize my stable channel from $100,000 and 0 native Bitcoin exposure to, let's say, $75,000 of dollar exposure and 0.25 native Bitcoin exposure. We can all do this with all Bitcoin under the hood. We can also add in interest rate payments, which modulates the demand for either providing or receiving this stability service over these Lightning channels. This is somewhat analogous to funding rates in perpetual swaps or perpetual futures in cryptocurrency derivatives markets. This is a way for users to get yield on their stabilized Bitcoin. Where does the yield come from? It's pretty simple. The yield comes from you giving up your Bitcoin volatility to your counterparty. Of course, this is hooked up to the Lightning Network, so we can add dollar-based payments in and out of the stable channel's wallet and in and out of the stable channel's app. A user can offboard from a stable channel to Lightning-enabled exchanges all across the globe in seconds. I think that stable channels, insofar as an open source and decentralized and peer-to-peer architecture, can also be good for financial privacy. Instead of going to an exchange and selling and KYCing and selling your Bitcoin on an exchange, stable channels provides an alternative that emphasizes financial privacy. And also, I believe that stable channels may be tax efficient in some situations. In certain jurisdictions, if you change from a Bitcoin asset type to a dollar asset type, you may incur capital gains taxes. This will be specific on everybody's situation and in everybody's jurisdiction, but insofar as stable channels is a synthetic dollar balance where there has not been an asset transformation, you go from self-custodial Bitcoin in your, for example, in your regular Lightning wallet to self-custodial Bitcoin into stable channels. There hasn't been an asset transformation at that point. It's more of a synthetic dollar hedging approach. And finally, looking forward, I believe that stable channels can be used for all sorts of perpetuals trading use cases. We can have other types of derivative exposures within stable channels and using Bitcoin as the store of value and settlement mechanism. For example, a user may not just want to have Bitcoin exposure and dollar exposure. This user here also wants stabilized gold exposure. If we have good price feeds for it and we can find counterparties who are willing to provide that, then we can offer that to the user. We can also offer stabilized S&P 500 exposure to the user or other types of derivatives products. And what can modulate the demand for providing these types of exposures is funding rates similar to perpetual swaps and perpetual futures, and we can pay those interest payments over the self-same Lightning channels. So this is a technical conference, so let's talk a little bit about the technical stack. This software uses Bitcoin Dev Kit and Lightning Dev Kit on the back end. These Bitcoin libraries are developed by Block Inc., which does Cash App, I think many of you know, and Spiral is the unit of Block who works on Bitcoin open source code. We believe that these libraries will be maintained well into the future. The program is written all in Rust. It works as a desktop application on Windows, Linux, or Mac, and it can also run in a server. And what are the primary code functions? The primary code functions are getting the prices, handling the prices from the price feeds, accounting and payments, of course, who owes whom, what, when, doing the payments, handling risk from your counterparty, and the user interface. So finally, a little bit about me and about stable channels. I was a former tech lead at JP Morgan Chase. I was the technology lead on building out their digital assets trading network, which worked with stablecoins and tokenized US treasuries. This product that I and my team have built has moved trillions of dollars since it launched several years ago. But I'm a longtime Bitcoiner, and together with the entrepreneurs and builders at this conference, I'm now focused on building products that will move trillions of dollars on Bitcoin rails. Thank you. So the status is that Stable Channels is in open source incubation. My work has been sponsored by the Human Rights Foundation and OpenSats. Thank you to both of those organizations. The main challenge that I've faced so far is making self-custodial Lightning easy to use for folks. Maybe in another conference we can document some of those challenges or discuss it in Q&A. And looking forward, I'm looking for ethos-aligned developers, advisors, and partners to work towards scale and commercialization of this product offering. So thank you very much. What we're going to do next is I'm going to demo the desktop application and the onboarding flow. And then for anyone who's interested, I invite you to download the desktop application, on board with, well, we'll talk about it. But first, are there any questions? And excuse me, do we have a microphone for the questions, please? Uh-huh. Thanks, Alex.
Yeah, so you mentioned it's peer-to-peer, which means you have to sort of find a counterparty, right? Are you going to demo how that occurs?
Yes, so it is peer-to-peer, so that's somewhat configurable. Right now, the counterparty is the LSP, which is my company. And so right now, my company is taking the long position on the trades. And so how that might work from a marketplace perspective, there's some options there. For example, it could be that the service provider is in the middle and has their Lightning node and is connected on one side with one user and on the other side with another user and is facilitating the payments back and forth. Or it could be just the pure bilateral arrangement where on some sort of bespoke agreements, these bilateral trades are set up via the software, if that makes sense. But right now there's not a marketplace for finding the counterparties at this moment. But that marketplace could be designed in several ways. I mean, one thing that I know that Lisa, the host of this conference, works on is, and I think she's presenting on it maybe, is liquidity ads, which is a way to advertise that you're interested in getting or receiving inbound liquidity on Lightning Network stuff. And so that goes over the Lightning protocol itself. It could also be, a centralized web application where it might be a little bit easier, where you can find counterparties who are willing to take either side of the trade. Does that help?
Hey, Tony.
Hey.
Great presentation. Thanks for that. Can you hear me? All good?
Yep.
OK, quick question. So this purely provides the stable exposure, right? The receiver can't really cash out that 100K USD and use it. Is that correct?
Well, I mean, they can use it insofar as they can use Bitcoin in a Lightning channel. So, but they don't have dollars, they don't have stable coins, they have
exactly.
Bitcoin.
So the use case is basically getting the stable exposure that
Correct.
I want to hedge part of my holdings onto this price, right?
That's the primary use case.
So eventually it's collateralized loan where you're just getting an exposure. You're not using the money, but you're just getting an exposure by putting up collateral. Is that correct?
So it's just interesting when you say using the money, you can make payments with this money, and you may be getting an interest rate with the money that you've stabilized. But again, it's not
dollars.
Really,
it's not really dollars.
It's not dollars, right?
Okay, so
it's stabilized.
So it
Bitcoin.
eventually kind of becomes a P2P collateralized loan.
P2P collateralized, pardon?
P2P collateralized loan.
P2P collateralized loan. I think that one way to think about it is that you're lending the volatility to your counterparty.
Yeah.
Or the counterparty is lending the stability to you, but it's not a loan insofar as you are putting up your Bitcoin and getting some other asset against that Bitcoin. So there's no repaying of the, yeah.
How do you close the channel? Like, I want to close my exposure. Like, how do you close that? Is that possible?
Yeah, it's a similar fashion as closing a regular Lightning channel. You can close the channel you create the stable channel with an on-chain transaction.
Yeah.
And you close the stable channel with another on-chain transaction that closes the channel. You can also, this isn't quite all there yet, but you can also offboard via Lightning and keep, a portion of your stable channel offboard via Lightning, or offboard via like a splice out of your Lightning channel.
Okay, sounds good. Thank you.
Thank you.
Yeah, hello.
Hi.
I have a question. So in your example, you've described that like you have two sets of users. One user is providing one Bitcoin, like another user is like providing another Bitcoin, but like on the other side. So
Correct.
You have provider and receiver. And in your example, they are kind of like equal in this exchange. They both provide one Bitcoin. What about scenarios when you have difference in number of users on the other side? So for example, like instead of like 50-50, you have a 25 to 75 split. How does it work in terms of like equation?
So this is somewhat analogous to perpetual swaps markets or perpetuals futures markets and cryptocurrency derivatives markets. And what modulates if there's an imbalance there, and so in other words, I just want to make sure I'm covering your questions here. And so if there's a market imbalance, in other words, let's say that more users are willing to take the long side than the short side, okay? So that means that more users are bullish that Bitcoin price is going up. Then that means that those long users have to pay an interest rate to the short users. And normally in Bitcoin, the BTC USD pair, around 72% of the time, that funding rate is positive, meaning the longs pay the shorts. And so on an annualized basis, it's normally around 10 or 15% annualized. Now we can pay that interest rate on the channel in very tiny increments, every 30 seconds or a minute, however you want to configure that settlement rate. But for a minority part of the time, it goes the other way. So if the market is significantly bearish, perhaps even right now, and we can look this up, it means that the interest rate payments go the other way. Now, that's just like talking like market-based. This system, insofar as it's a peer-to-peer setup, can be used in different types of financial arrangements. We're talking about in the market, in a more marketplace arrangement, right? But maybe we have an over-the-counter deal, just me and you, that says, hey, I'm going to pay you 10% annualized to keep you stable. You're giving up your Bitcoin volatility for the next 3 months or whatever it is. You're a business, I'm a business, we have this agreement, we sign it, and we use the Lightning channel as the mechanism to settle this payment while you can retain custody and I can retain custody. So my point is this, that there's the marketplace aspect, which is well developed with Binance and Deribit and different types of market solutions that offer cryptocurrency derivatives solutions. There's also what would be called like the over-the-counter deal, which is more peer-to-peer bespoke financial agreements between two counterparties. Now that's one side of your question. I just want to mention one other thing, which is just in case you were saying like, well, one side puts in one Bitcoin, one side puts in one Bitcoin. It doesn't have to be that way. One side could put in one Bitcoin at $100,000, and the other side could put in 1/10 of a Bitcoin, for example. But in that case, you have a lot less wiggle room if the price of Bitcoin goes down before one side essentially gets liquidated. So there's a lot of different approaches that we can do here to amp up the leverage or subtract the leverage. But at the end of the day, we're using this Lightning Network to settle these trades. Did you have a follow-up question on this, or?
No, I think like it's good. So basically, like you're saying that leverage is going to be something that can change the equation. So like if there is more users on the one side of the equation, that means that other side is going to get higher leverage, and like vice versa.
There's going to be an interest rate that modulates the demand for providing or receiving the price exposure based on market appetite at the time.
Okay, yeah, that makes sense.
Hey, what's up, Tony? Good presentation. I just have a question about, so you, I've been following this project since the beginning, as you know, and it seems like this LSP that you have is sort of a new development. I was wondering if you think that it might be risky to run an LSP that offers effectively US dollar bank accounts. I mean, obviously it's very different from that, but I feel like if I were starting that business, I'd be worried the US government would sort of see me as like a bank that offers US bank accounts and might come after me. Do you have, have you thought about what you would do if that happens? What the legal risks actually are?
Yeah, I bucket the risk with this product in three separate categories. There's technology risk, which is the risk of using self-custodial Lightning and all of the edge cases with Lightning. And those risks are getting mitigated over time as Lightning matures. But what I think you're asking about is what I would call the second two buckets of risk, which would be the operational risk and the regulatory risk. Let's take the operational risk on one side. With the operational risk, there's obviously price risk involved with this solution. If you're playing with leveraged Bitcoin at all, there's a risk that the price of Bitcoin plummets. And this solution doesn't work, obviously, if the price of Bitcoin goes to zero. There's not enough Bitcoin to keep anybody stable in any type of asset. Additionally, in the operational risk bucket, there is the risk of keeping custody of your own Bitcoin and providing a service that can effectively keep custody of the user's Bitcoin, and so that the user is capable of self-custodying their own Lightning Bitcoin. And this involves Lightning backups. It's not easy. Self-custodial Lightning is not easy. But finally, let's get to the regulatory risk. And so this system is truly self-custodial. And so in the United States jurisdiction, generally, self-custodial developers are protected from regulations which regulate businesses as money services or money service businesses or money transmitters. So that's one bucket of regulation. Another bucket of laws and regulations is derivatives regulations and derivative product offerings. Again, it's my assessment that the bucket of self-custody will preclude a lot of those regulations because there's just not. It's just a different can of worms from regulated futures, regulated swaps, the self-custodial aspect is really quite key. I need to be very careful, and my service needs to be very careful with how I present all of these risks to the customers, and that we do so in a forthright and totally honest manner. And additionally, I'm following very closely the development of the Clarity Act in the United States. The Genius Act, which covers stablecoins in the United States, is not directly related to this product offering, but the Clarity Act has some sections in there which may offer US congressionally approved protections for developers offering self-custodial systems. So let's hope for that.
Yeah, so just specifically what I had in mind is that like the bank lobby would want, like they would see you as competition and they might try to force you to like get a bank charter, like to register as a bank. Like have you thought that maybe they might try to do that, even if it's like a self-custodial bank?
Yeah, in my time at JP Morgan, I was closely attuned with all of the banking regulators and financial regulators. And the banks are regulated to a tremendous extent. They're frankly, basically a fourth arm of the United States government. And so with this solution, insofar as we can definitively say that the user has clear custody of their funds, I don't see why we would be regulated as a bank. We don't touch the traditional finance system. We don't have direct access to users' funds, and there's obviously reasonable guarantees of user self-custody. We don't touch US dollars. So, but to your point, I do think that there will be resistance for any type of Bitcoin-backed product offering, any type of Bitcoin-backed dollars. So, Chris, I do expect that. Any other questions?
Hey, I think I have a couple of things. First is the system, you said it doesn't work when Bitcoin goes to zero, but it also wouldn't really work if the price goes down by 50%, right?
Yeah, exactly. So here's some sample payout scenarios that we have. So in the beginning, when each user put in 1 Bitcoin, obviously each user has 1 Bitcoin on the channel. If the price goes down 50%, then that means that both of the Bitcoin on one side of the channel and the long side got liquidated.
So basically, if it drops by 50%, the user has to get out of it.
If it drops what?
By 50%, the user has to get out of it, because beyond that, there is no stabilization possible, unless the LSP kind of like,
Yeah, exactly.
keeps topping up the...
So if the price of Bitcoin plummets, there's several options, and I've listed them here. And so one is to keep the operations going where essentially the LSP gets margin called and needs to splice in more funds to recollateralize the stable channel. Another thing is to recharacterize the Lightning channel to a regular Lightning channel. The user can also offboard using Lightning to an exchange, or then the user can also offboard on chain. They can splice or close the channel, or we can auto swap the user auto swap the user from stabilized Bitcoin to a stable coin.
Okay.
So those are all options, and when it comes to Bitcoin price volatility, there's no free lunch, as we know. So the question is how we manage the user's expectations and expect those failure scenarios to happen so that we can handle them when they come, so that the user's not totally not surprised, but that we can handle that gracefully.
I think that is one of the things where you're going to face, real challenge from users. Like, what are you going to do about it? How are you going to notify them, and so on.
Yep.
My more important question was, have you thought about the Oracle problem?
So what was it?
The Oracle problem.
The what?
Oracle, like
Oracle. Yeah. Yeah. So with the oracles,
that's where the whole thing, the real problem is, getting the price feed in.
Yeah, I have a little different opinion on this. So another way to offer stabilized Bitcoin exposure is maybe with something like a DLC-based approach, discrete log contract. And those solutions work a little differently because basically you involve, you got your two trade counterparties, and then you have a third party who's the price oracle who effectively does a digital signature, a cryptographic signature, which can adjudicate the trade going one way or the other. Now, that's good for users who need really strong granularity to settle the trade in 3 months' time, one way or the other. But the ecosystem of price oracles that do Bitcoin digital signatures to adjudicate this trade for just DLC-based oracles has not been developed yet. So what ends up occurring is that a number of these DLC companies end up running the oracle themselves. There's a specific company called Lava, which has gotten in a little bit of trouble with that recently. So I think that the DLC design is a little bit aspirational. Instead of doing that type of design, which gives effective partial custody to your DLC oracle, what Stable Channels does is we use regular exchange price feeds. But what we do is we use 5 of them. And these are all big companies, like I mentioned, Coinbase and Binance. So each software goes out over HTTPS, secure, cryptographically secure connection to Binance.com, to Coinbase.com, gets the price, and then of those 5, we take the median of the 5. And what that protects against is, if the price is $100,000 and 4 of them give you a price of $100,000 and the 5th gives you a price of $1 million, well, that 5th one is going to get thrown out. So in this respect, the stable channel software takes those price feeds in, and then the software can make an intelligent choice about what to do. Because effectively, the user still has total custody of their funds. They're not giving effective partial custody to, for example, a DLC price oracle. So that's the approach we've taken. In traditional finance with reference data, there's all sorts of rules and regulations around doing this, but we're doing the best we can with tools that we have right now, and I hope that in the future, for example, this Oracle ecosystem will be more developed.
I think that is where you're going to face some challenges because the math of it is fine, but you are the one who the user has to rely for the price. So if you are the LSP and you're also providing the price oracle.
No, we're not providing the prices. The user directly goes to Coinbase.com and gets the prices.
That's fine, but the point is that your software is configuring it, or your software is getting all those prices together.
That's true.
And if you on your side feed a wrong price in on the LSP side, and the user has a wrong, some other price, then there will be
there's definitely discrepancies. This solution is not perfect, and there might be a little bit of fuzziness around this. But the way I think about it is that if you're trying to keep a basket of Bitcoin stable in dollar terms, the price of Bitcoin changes every minute, basically. So we make a best effort on this, but I take your point that there's a lot of challenges around price oracles.
Going to be the most interesting part of this, how you solve the oracle problem, basically.
Thank you. Any other questions?
Hey Tony, thanks for the presentation and thanks for all this. Actually, great. Usually, I find it's been my experience that when people tell you 10 reasons why this will never work, it actually means it's a good idea. So fantastic project.
I appreciate that.
Just one more way things can fail. You mentioned trusted. Reputational business counterparties like your company. You mentioned like paper contracts, business arrangements for these sort of things, but in let's call it like a more decentralized or anonymous marketplace, isn't there a possibility that if I, let's say, open a contract with you, just like peer-to-peer, right? Things don't go my way, I just simply don't send any payments.
That's right. I think that's going to happen, and I think it should be expected, frankly. So there's a couple of ways to handle this. One is that on the service provider side, I can tell you that my company will hold up its end of the bargain. So then what we're dealing with is when the users basically disappear. And so in that respect, there's a couple ways to handle it. I think the simplest way to handle it, perhaps, is to take a security bond or to take 5 or 10% of the channel balance and to protect against the user not paying. But effectively, the user needs to be a good trader, or their software just goes off, they just close their computer, their software goes offline. Because the price can move quite considerably in 5 minutes, that's true. But the user needs to know, when to stop paying, because they may stop paying at, whatever, 12:01, and then 12:02 the price goes the other way for them. So my software keeps track of who's paying when and when they're not paying. Another way to handle it is basically KYC and to charge the user if they don't pay. But that is a limitation of this design, and it's a limitation of providing pure frequent settlement with this self-custodial approach. There are other solutions that involve like price oracles, DLCs, that can mitigate that particular risk. And there might be, in my opinion, there might be some sort of hybrid approach which uses stable channels and DLCs in the future where we can get the best of both worlds. Any other questions? I've got about 17 minutes left and I want to get to the demo, but we can still take another question. All right, let's get to the demo. So this will be a, a live demo, so. So I mentioned that I built this LSP dashboard, and this is what I show on the right-hand side of the screen. I know it's small. But basically, this just shows the channels that are open on this particular LSP. And I'm going to go ahead and start up the application. This is running from source. As mentioned, this is a Rust program. And this will initialize the LDK node. This will start up the node and should start up the user application here shortly. And then what happens is that the user application connects to the LSP node. And so we've already gotten, I mentioned the price feeds. We've already gotten the price feeds from these exchanges, and we take the median. But this is all back-end stuff. This is what the user sees. The user sees this. And so we've started the user up with their own Lightning node, and the user presses this button, and this is going to query the LSP for a Lightning invoice. And this uses something called just-in-time channels. So, so the user onboards from their exchange or from their Lightning wallet. In the future, we can also offer on-chain onboarding. So I'm going to open up my Cash App wallet, and I'm going to effectively send myself Bitcoin. So I've just submitted the payment and put my Face ID in there. And what's happening on the back end is that we just created the channel. That means that an on-chain transaction was broadcast to the Bitcoin mainnet. And what's going to happen now is every 30 seconds the software will update. And this should show up here at the top with a stable balance of $100 here shortly. But what happened was the user sent the payment from their well, this was Cash App, right? And then the payment was routed through the LSP, which I'm running. And the LSP intercepted that payment, basically. Intercepted that payment. This is called just-in-time channels. And then went ahead and submitted an on-chain transaction and pushed $100 over to the user side of the channel. And so now the stability mechanism is activated. So there's $100 on one side, $100 on the other side. And every 30 seconds we go out and we get the latest price. And then if there needs to be a a settlement payment made, then there is. And we keep the user stable to $99, 99.9%. So if this balance goes above $100.10, then the user will send a payment. Or if the balance goes below $99.90, then the user will receive a payment from the LSP. So yeah, these keys are on the computer here. And then this is what I'm working on right now, which is maybe the user wants to buy some Bitcoin with their stabilized Bitcoin balance. They can come in here and they can basically send a message to the service provider, which does a trade back and forth. So ideally, we can offer different types of financial products within this channel-based construct. So what can the user do here? Not so much quite yet, really, but ideally they can trade. Ideally they can get interest rates. Ideally they can send and receive dollar-based payments and have other types of assets as well with all Bitcoin under the hood. Yes, Chris? Yeah, right now it's only $100. The current status is, as I mentioned, Windows, Linux, Mac. It's also in the Mac App Store if you want to download it from the Mac App Store. And it's just $100, no more, no less. And that's to minimize risk while we work out all the bugs. Yep. Well, we got 12 minutes left, so I don't know if anybody wants to try it out, but anybody can try it out if they want to. And otherwise, any other questions? This gentleman has one more question.
I have a dumb question, but
Nope.
your stable balance is changing all the time. Like that's your amount of US dollars is fluctuating. Yeah?
Yeah, so that's actually literally how much money there is right now. And what I mentioned is that we only do the stability payment if the user's below in this case $99.90 or above $100.10, because it does, in my mind, it doesn't really make much sense to do payment of pennies. So we have like the minimum payment of 10 cents in this case. If we really did payments to do like pennies, then I mean technologically it's perfectly fine. It just blows out your database with all those payments and just makes. I'm not sure if it makes sense, but I think what I ought to do is on that big balance there, I should show like just $100, and then if it actually goes below, like maybe in like smaller font, show the actual like real-time value. I don't know. I'm still thinking about that. I'll take suggestions from you guys. Yes, sir.
Hi, Tony. This
Hello.
question's a bit of a tangent, but you mentioned DLC providers also being their own oracles. Have you thought through who, if anyone, or even if it's possible for someone to have an oracle business in Bitcoin, and why we haven't seen that? Obviously, Chainlink is kind of a thing in another world, but I have not seen the equivalent, and I wonder, as someone who's been in this problem space for a while, what you think of that. Who's going to run the oracles?
Yeah, so I don't know. And that's the reason that I'm like a little skeptical of DLCs, because that ecosystem has not developed. In my opinion, and Chainlink seems to get around this okay, but in my opinion, there's a legal or regulatory risk with running an oracle, because you're kind of taking partial custody of the money in a way. And like, for example, if your infrastructure gets hacked or your infrastructure is compromised by an internal employee, then some other trades might go askew. So I think that might be one reason why we haven't seen them. There's just also there's not really like DeFi on Bitcoin. Like Ethereum has a lot of DeFi, so Chainlink's can do a lot of business on that one. And Chainlink's got their own token, so That's another angle. And I think Chainlink, you might have to pay with their token to. I'm not totally sure.
Do you know if there is any analog information provider in the traditional finance realm?
Oh, there's like, you know, for example, Bloomberg provides reference data for
to the point where they
services.
take some sort of custodial financial responsibility. I don't know how that would be called, but like, because I assume if Bloomberg publishes a certain piece of information, trades are executed on that, and they have some responsibility. But I know nothing about the regulation there. I imagine some of it's built out, which is why I'm opening it.
It's a good intuition, and I can tell you from my time in TradFi that this data, which is called reference data, is very highly regulated, actually, and there's a whole number of rules all around it.
By which body?
You know, probably the Securities and Exchange Commission. Probably it might be some informal regulations like trading associations, stuff like that. Yeah.
Okay, you're giving me some roots to look into. Thank you.
Oh, thank you. Any other questions, folks? All right, y'all. Hey, thanks so much, and I'm around all week for questions. So thank you for your time.
Fantastic. All right, thanks everyone for coming and choosing to come to this workshop. I hope it's a lot of fun for you. It's good to see a few of you have got some laptops. Those will come in handy when we get to a hands-on section. So I'm Nick Farrow, one of the co-founders of FrostSnap, and we are making a next-generation hardware wallet based on Frost multi-signature. I thought I'd start out, I might just give you a quick demo of what it looks like to create a Frost multi-sig using these nice hardware devices we've built. Then I'm going to do a little bit of explanation of how Frost works, and I'll try and get all the bits and pieces right. It's good we've got Lloyd in the audience, so Lloyd, please shout if I miss anything or if I get anything wrong. And then we will make some Frost keys together, and we'll actually do this in groups of 2 or 3. And if we've got time, we might make a massive multi-sig at the end. If you want to, so I'll get to how we're going to make the Frost multi-sig together a little bit later on, but you can either use web tools, or if you have Rust installed on your laptop, you can actually clone the Rust repository and build the command line tool yourself. And we're going to communicate messages over Nostr to make a Frost wallet and maybe sign some fun stuff afterwards. So yeah, this is FrostSnap. These are our daisy-chained hardware wallets, and it just makes it super simple to make a multi-sig. I'll fix that just quickly. There we go. So this is what Frost hardware wallets look like. They're double-ended USB-C, and you just daisy-chain them like this, and we have a FrostSnap companion app, which talks to the devices. I'll try and get this in view. So this is the app. This is a blank one. I don't have a wallet yet, and I'm just going to I'll try to get this in focus a little bit if I can. Oh, maybe not. Okay, it might be a little bit hard for you guys to read this, but this one says create a multi-signature wallet. And I'm going to choose a name for this wallet. Just call it Taipei. That seems good focus there. Cool. And now I need to plug in the devices that I want to be a part of this wallet. You'd usually do this on a flat surface, like a table, so it's got nicely supported. And you would connect the devices you want to be a part of that wallet. I've connected 3 devices. Maybe I can make this closer. Let's see what we can do here. Oh yeah, that's better. Slightly. How's that? A bit better. So yeah, I've got 3 devices, and we're going to make a 2 of 3 multi-sig. So I'm going to click continue with 3 devices. The devices are going to do a little bit of setup. If you saw Lloyd's talk earlier, there was this mention of these things called nonces, which we need to pre-share in Frost to make signing only take 1 round. So these devices are sharing nonces at the moment with the coordinator. How many nonces is it, Lloyd, at the moment? You think
30.
30 nonces?
No,
So
30 times 4.
30 times 4, yep. And now we can name the devices. So I'm just going to call them, I'll just name them the same color as the cases. So I'll go silver, black, and orange. And we'll go next. And on this screen is where you choose your threshold. So you can do a 3 out of 3. You can even do a 1 out of 3 if you want to. But let's do a 2 out of 3. And I'm going to click Generate Keys. And if you saw Lloyd's talk earlier, he mentioned the amount of work we put into getting this security check nice and small. It takes a few seconds to grind the fingerprint, and there it is. So it's a little bit hard for you guys to see, but you can see that code matches on all the devices. And what that means is that everyone has acted honestly. And what that means, we'll get to in a little bit. And so the device is a touchscreen. You hold to confirm on each device. And final check. And we're done. And then we've got a Bitcoin wallet that we can send and receive to. Now, when you're signing, you can sign on 1 device at a time. I'm not going to show you the signing stuff just yet. We'll get into the Frost of kind of like how it works, a little bit of the basics of the theory, which hopefully is interesting to you guys. And I find it very interesting. It's very beautiful mathematics, actually. It's very, very elegant and very powerful. Because it's so simple at like the base level of the mathematics, it lets you do some very exotic things later on, such as, say I've got a 2 out of 3, I could add another device in and make a 2 out of 4, or we could make a separate 3 out of 5 that accesses the same wallet. And we're able to do that because the mathematics of how the shares are, how the system's designed, it lets us do that. So just taking a step back is like, why are we doing multi-sig? Why are we doing Frost? Why are we doing multi-sig? Our primary goal at FrostSnap is to get your life savings outside of your home. So not having a single sig hardware wallet at your house, because that makes you very vulnerable to physical Bitcoin attacks and coercive threats and confiscation. Multi-sig is also really, really good for disaster recovery as well. So you can lose a device and you've still got the other 2. All right, so secret sharing. Secret sharing, we have if you saw Lloyd's talk earlier, he touched on it briefly. So we have a secret S, and this is usually a private key, or maybe it's some secret information you want to encode. And I have this secret, and I want to split it amongst you guys. I want to give you each a piece of this secret, and for you to find out this secret, you need to sort of collaborate together in this sort of a multi-sig, maybe 5 out of 10, or really whatever we want to reconstruct that secret and access the private key. So we do this, and sorry for the mathematics, we'll do some visual stuff in a second on paper. But basically how it works is you generate a random polynomial, and you set this constant term, A0, as the secret. And so you generate a random A1 for the second coefficient, a random A2 for the third coefficient, and so on and so on. And then what you do is you evaluate this polynomial at a bunch of different share indices. So we would plug in f of function of 1, which will just be our constant term plus x squared. Our constant term plus a2 plus a3, so on and so on. And then for person 2, we would plug in x equals 2, and you end up with all these shares that sit on a polynomial. And we'll do a quick example. So say my secret is 12, the number 12, and we want to do a threshold 2. So let's make it 2 out of 3, and we want to have this secret number 12. You know, private key is usually much, much bigger, much more complicated. And so what we do is we generate a random degree t minus 1 polynomial. So we have f of x is our secret plus some random a1 times x. I just made a1 3, so just pulled that out of random number generator. So this is our polynomial now, 12 minus 3x. And if we plug in 1 into that equation, we get the first share is 9. If we plug in 2, the second share is 6. You plug in the f of 3, we get, what do we get? We get 3, and then so on and so on. You can generate as many shares as you want for this, this polynomial. And the way we reconstruct it is you have these unknowns, right? You have in this equation there's 2 unknowns. There's s and a1, and to reconstruct to learn what s is, we need 2 of those shares. As then we get 2 equations and 2 unknowns, and if you remember your high school maths, we can solve those equations and get back what s is, our secret. This diagram on the right, this is a higher degree polynomial. So this is like imagine a 3 out of 5. And so you would have a quadratic polynomial here, and the important thing to note is so in a 3 out of 5, if you only have 2 shares, you don't get enough information to reconstruct. You don't know which polynomial it is. You need a third point to pin it down. And so, yeah, on this picture on the right, there's only 2 shares sort of pinning down the polynomial, and if you had another share somewhere, it would really fix that in place, and you would know what the secret is. And usually this is done through Lagrange interpolation rather than actually solving the system of equations. So maybe let's do that quickly on some paper. Just visually, how does it work? So hopefully you guys will be able to see this also. So let's just draw what it sort of looks like. So let's say this is our secret, and this is 12, and I don't know what my equation was before. We generate a random function, so it was f of x equals 12. I think I did minus 3x. So say I pulled that first coefficient randomly, and now we want to generate shares. So yeah, f of 1 is 9, f of 2 is 6, and f of 3 is 3. Cool. So now the first share is 1, 9. The second share is 2, 6. And the third share is 3, 3. Now, I would give these shares out to the people I want to hold, a part of this secret for me. And if we can draw these on this very out of scale graph here. So say this is 1, 2, and 3. And so this is the first share here. This is 1, 9. Second one somewhere here, 2, 6. And the third one is here somewhere, 3, 3. Now you notice, to reconstruct this S, to find out what this S was, all we need to know is, this is very messy here, sorry, but we need any 2 of these 3 points to reconstruct what S was. If we only have 1 point, we've got no idea where S is, but the moment we've got a second point, we can pin down S, and we know what that secret is. So that's the basics of Shamir secret sharing. But Shamir secret sharing, it's not great. So the problem with Shamir secret sharing is that we have a trusted dealer. It's me making this random polynomial and I know the secret, and I make this polynomial, and I make the shares, and then I give you guys the shares. And you kind of just have to trust that I actually, firstly, that I made the shares properly, that I just didn't give you bogus garbage. And you also have to trust that, I've deleted the secret after. You could think in the context of Bitcoin, say you're making, you want to make a multi-sig using Shamir secret sharing, you're still going to have to trust a device a single device to generate those shares and then distribute them. And generally, we're trying to increase our sovereignty from, potentially malicious devices or hardware or manufacturers who would like to sort of distribute that across multiple devices or multiple people. So yeah, a malicious dealer can steal the Bitcoin is really the problem with Shamir secret sharing. So getting into Frost. So one of the core components of Frost is the distributed key generation. So how this works is it's kind of like each individual person does their own sort of Shamir secret sharing thing. So they generate their own polynomial, and they evaluate their own polynomial at these different indices, like we did for Shamir secret sharing, at x equals 1, x equals 2, and so on and so on. And then they send those evaluations to, they send them to all the other participants. So if I'm party 1 and Dan's party 2, I would evaluate my polynomial at x equals 1. I would keep that one for myself. I would evaluate it at x equals 2. I'd give that one to Dan. I would evaluate it at x equals 3. I might give that one to Adam. And those guys would do the same. So they would have their own polynomial. They would give me shares. Adam has his own polynomial. He gives me shares. And at the end, we just sum up all these keygen shares that we receive. And I'll show you what this gives us. So we'll do this on paper as well. And this one's a bit fun, actually. It's going to be a bit more interactive. So Dan, can you give me a nice small number? Let's make we'll make your party 1. And let's make your secret scalar polynomial. So give me a small number, Dan. Something 3, perfect. So that's your first coefficient. And another one, another number, 5. Yep, 3 plus 5x. We'll just do a 2 out of we'll do 2 out of 3 just to keep the math simple. Party and we'll do the shares in a second. And party 2. Who wants to be party 2? Someone I don't know. Yeah, Shinobi. Get out. That's still high. We'll do 10. It's a nice, convenient round number. And something else? Oh man, you're gonna make me divide by 7 and stuff. All right. We'll see where this goes. I haven't done this in a long time, so bear with me. That's why we write code, so we don't have to do it by hand. Who wants to be the third party? Yeah, Alex? 6? Evil man. All right. Cool. So you guys have generated your secret scalar polynomials. Usually you wouldn't share these with me, but just so I can, show everyone how we're working through this. And so Dan, you're going to plug in, you're going to generate your keygen shares now that you're going to give to the other parties. So f of f1, which is your polynomial of 1, what does that equal? 8, and f1 of 2, what is that, 13? f1 of 3 is, what is this? No, oh yeah, 18, yes. That was 13. Cool. And for party 2, $24 and $31. Cool. I'll just go some shorthand here. And party 3, F3 of 1. What is that one? Oh, you guys really gave me some big numbers. 13. 2, 20, and F3 of 3 is 27. Awesome. All right, so now we've made these keygen shares, and then you would distribute them amongst different parties. So all the, maybe I'll rip this one off, put it there. All right, so we've got our shares. And now, so what does party 1 receive? Party 1, they keep their own one, so they keep this F1 of 1. And this is going to be their secret share, so S1. And so they're going to be F1 of 1 plus F2 of 1 plus F3 of 1. Which equals, so it's this one plus this one plus this one, which is 38. S2. That's party 2. What is their secret? 13 plus 24 plus 20. What have we got? 44, 57? 67? $57. Party 3, 76. Awesome. Cool. And so we've got these secret shares. Okay, what the hell did we just do? We've got these secret shares. What do they, what does this look like visually? What have we actually just done is sort of the question. So we've got these secret shares, and I'm going to draw visually, like kind of what Frost distributed key generation is sort of doing. I'll try my best here. Oops. They're all positive numbers, yes. All right. So I'm going to draw these scalar polynomials, these secret ones. So the first one is intercept at 3. And it's got a pretty steep slope, something like this. This is going to get really insane. Next, we'll do this one at, say this is 10. This one is even steeper. Okay, these are going to be really steep. But we've got two 7x's there. And at 6, okay, we really should have made one of these negative to like not really cramp up the y-axis. I don't know if it's too late to change that. Maybe. Too late to change it? What do you think?
Draw it, but with it.
Huh? We've come too far. All right. So.
Just draw it with a squish down it, so it's the
Oh yeah.
gradient is
Yeah,
much
true. That's a
lower.
smarter idea. That's a smarter idea. Got these crazy 3, 6, 10. We'll just say it's, yes, the x-axis is 3. And I think these two had the same gradient, yes. So we've got this is our F1, F2, I think I'll let this back to front, F2, this one's F2, that one's F3, yes. That one's F1. And really what we've actually done in this key generation is we've evaluated each polynomial at indices 1, 2, and 3, and same for this one, 2, and 3, 1, 2, and 3 up here somewhere. And so these shares, these ones here, the evaluations of these, sorry, it's very messy. Evaluations of these scalar polynomials, we add them together and we get our secret share for the first party. So we add these three numbers up and we get something way up here at 38. And we add participant 2 adds their ones up and they get some other, sorry, we've flown into the other graph, 57. And the other third party gets 76. And you'll notice the special thing here is I really made a mess of this, but we've got this new line, we've got this new polynomial that no one knows the secret to. Nobody knows what A0, or nobody knows what this plus this was. These constant terms that we've added that we have. So we have this new line that these shares interpolate to some secret that is the sum of these constant terms from each party. So we've actually done something quite amazing here. We've made a secret without that secret ever being in any one place. And to reconstruct that secret, like before, any two of these three shares can reconstruct that secret. So that's the sort of how distributed key generation works. You can imagine that extends to higher thresholds, like 3 of 5s, 5 of 8s. It can go on to as big as you like. Yeah, but that's sort of the big picture of how distributed key generation works. And yeah, the really special thing to take away is that nobody knows that the group private key is 3 plus 10 plus 6. So 19. We've actually got some group polynomial that no one knows the first coefficient to. And then from that, with Frost, we can actually, the special thing with Frost is we can perform signatures under that unknown group private key. We can perform signatures under that group private key sort of piece by piece. And I'm not going to do that one on paper as it gets really messy, but essentially participant 1 can use their secret share and they can sign sort of a piece of the signature, and person 2 can do the same with their secret share, and then you can actually use some Lagrange interpolation to combine those secret shares, to combine those partial signatures into a signature that's valid for this group private key, 19. Does that kind of make sense? Is it kind of following, or are you guys completely lost? It's good? Cool. Awesome. Awesome. Feel free to interrupt if you have any questions also. Pardon? Sorry? No. Sadly, it's not quite that simple. So there are some tricks an evil party could do to sort of try and rig the game. They can sort of cut their keys in a sort of way that makes their keys cancel out your keys. So maybe, for example, like, I'll go back to that screen. So in this example, if party 3 went like, if we did this really naively and we just let people generate their scalar polynomials and send stuff out, parties can, like, if the last person to sort of put stuff into this key generation, they've seen what everyone else has given them, and they can, like, change their contributions to cancel out everyone else's. And so they could choose their polynomial such that it's going to cancel out the other people's polynomials. And essentially what that ends up as is they know the secret, so they can rig the game. And so yeah, sadly with the distributed key generation is we need to do a few other things. We need to, one of them is we commit to our secret polynomial. We say, here's what my polynomial, here's the image of my polynomial, here's what it looks like. and then we share that first before we then share the keygen shares. And we also make a proof of possession, which is essentially just a signature, a proof of knowledge, saying that we actually know the constant coefficient term, our A0. It proves that we actually know that, and we haven't tried to game anything to sort of cancel out everyone else's contributions and cheat the system so we know the private key alone. So essentially the implications of these security requirements is this leads to extra rounds in Frost. So it's pretty quick, half an hour. We are now going to do a workshop, which is hopefully a bit of fun for you guys. Get into like groups on your table. It helps.
Sorry.
Yes.
So I just, Adam discovered that there's a problem with your cargo dependencies in that thing. So he's got a pull request. You want to merge to fix the cargo dependencies.
Perfect.
Because you used like relative path dependencies for.
Did I?
Yeah.
Oh, that was
So, like,
probably
local-
vibe coded. Wait, really? Oh, that's crazy. So if you've got a laptop, please clone this repo. Or if you don't have Rust installed, so you made a pull request. If you don't have Rust installed, there's also a web version. So go on Yushan, which is I've learned is Taipei or Taiwan's highest mountain. It's frosty all year round, apparently. On yushan.frostsnap.com, and it'll bring up this website, and you can either download the tools yourself, or you can actually run it in browser. So if you're allergic to Rust, you're allergic to crabs, you can actually run it in your browser. And we're going to make some Frost keys together, and hopefully sign some things together. Maybe we can sign a Nostr post. Could be a bit of fun. So go on yushan.frostsnap.com, and yeah, I'll give you a few minutes to get onto that while I merge this pull request. Oh, crazy. Thank you. If you've already pulled the repo, you might need to git pull it again. Who's got this web page open? Anyone? Alex has got it. 2 Alexes have got it. Maybe we all just make one. Maybe we just make one big multi-sig. Maybe we just try that. Might be a bit risky. Let's try it. So we've got those two. Who else is going to join our multi-sig? Lloyd's going to join. It's a good question. It's kind of the same. I can show you what it looks like. So the website one, it'll just spit it out. It's essentially giving you the exact same output as the command line would. And there's a few sort of learning things dotted in there. If you want to like really get down in the weeds of what's happening, you can read through what the terminal output is. Click this one. So I'll just give you guys a few minutes to get set up. And, oops. Yes, good point. So if you're doing it in browser, you should have this page open on one tab, and then these tools, the web tools, open on another tab. Maybe split them out like this. I'll do that so you guys can follow along. We'll keep the room ID as Stay Frosty for our big multi-sig. If you guys want to make your own multi-sigs amongst yourself, choose a different room ID, please, or else we'll end up in a bit of a mess. So hands up if you want to join the big multi-sig. Lloyd, you're in the big multi-sig. 2 Alexes. Yes, maybe. All right, we're going to go Stay Frosty 2 for the big multisig. So everyone go Stay Frosty 2, and we need to choose a threshold, and number of participants is also, we've got to figure that out first. So we've got 3 over there, or maybe 4 over there. Adam, you joining this one as well? All right, 4 over there. Who else? So guys on the left side, you going to join the multisig? Yep. All right, we'll go 1 over there, or 2? 1, cool. Anyone else? Shinobi? All right, you're in. You're committing to participate in this keygen process. If you disappear, we're going to have to restart from scratch. All right, so 4, 5, 6, 7. All right, so we've got 7 participants. Everyone put 7 in. And let's keep the threshold nice and low. We'll keep the threshold as 2, because it'll be a lot of fun if we can all just be signing stuff. So make sure that you're on Stay Frosty 2 with threshold of 2 and a total number of parties of 7. And I'll just give you a minute or so to get set up there. And oh yeah, also do the same. Make sure to do the same in the browser tools as well. So we're going threshold of 2. And this is also going to be a little bit tricky part. So each individual needs a unique participant index. So I'm going to make myself number 1. Lloyd's number 2, Adam's 3, Fetty Alex is 4, Frostsnap Alex 5, and I don't know your name, sorry. Karthik? 6. Oh, Shinobi, 7. You're 7. All right. So make sure you get your participant index correct, or else you're going to be conflicting with someone else, and your messages won't pop up. Cool, you guys ready? Good to go? Oh, really? It might be ad blocker, I don't know. Lloyd's going to do some investigation here. Awesome. All right, so now on our tools, we're just going to hit run round 1. So everyone hit run. Oh, you can. Yeah, you should. You should update and subscribe. But that's important when we're pasting stuff in to communicate. So run keygen round 1. We've generated a scalar polynomial with a threshold of 2. So it's just a linear equation. It's like, y equals mx plus c or whatever it is. And we're going to evaluate this scalar polynomial at 7 indices from 1 to 7 for our 7 participants. So at the end, we'll have 7 secret shares. Okay, this is the stuff we need to communicate. So these are our polynomial commitments. And so what you're going to do is copy that to clipboard and just go over to the other website, go to the other page. Oh yeah, great, people are already chucking me in. Fantastic, we've got 2 out of 7. So I'm going to broadcast mine, paste it in. We've got 5 out of 7, 6 out of 7, fantastic. Waiting on one more, on party 7, Shinobi. It's all good, no rush, but it's going well so far. Everything's working. If you're curious, while those guys are figuring it out, I've been having a lot of fun using Nostr as like just a communication, like a really hacky communication layer. Like this is all done in the front end. Like you're just pasting stuff in, it gets sent to Nostr, and then your laptops are listening to that particular room ID or channel, and it'll just receive that in a stream and then display it. I've had a lot of fun making things with this sort of, it's almost like a hacky chat room, just using Nostr to broadcast stuff around and share things. So there's no back-end server on this. Any questions about FrostNap while we wait, or anything about Frost? Nope. When's Frost coming into Fedimint? Oh, they're distracted. We might, it's like a remote resource thing. All good. Too locked down. You could, but you would commit to your polynomials on your laptop in your local browser storage, so he wouldn't be able to take over later on. Yeah, you could steal it, or someone else. Does someone else want to be number 7 while we're... Yes? Perfect. Fantastic. Fantastic. Awesome. So just to remind you, we're on Stay Frosty 2 with a threshold of 2 and 7 parties. And first one to steal index 7 gets it. How's it going? Sorry? Oh, did it go through? We're still in 6 out of 7, so did you copy this thing and paste it in, or not yet? Oh, you did? Check, oh, interesting. There could be bugs, I must say. The biggest one I've done is a 2 out of 3, so we're being pretty ambitious here, going for 2 out of 7. Is it bug load? Is it just like... Sorry? Oh, I got you. Great. 7. Awesome. Nice work. So now we've got all 7 parties' commitments to their secret polynomials. We can copy these group commitments. So click that copy all button. That should have showed up. You should see 7 out of 7 now, and you can copy that. And on the Web Tools page, you can just paste that in and run keygen round 2. So we've received our 7 commitments from other parties. We and also their yes, and then we're gonna send out their keygen shares. So these are the shares that I've calculated to send amongst you guys, and your computers will do the same. It's not encrypted. Good Lloyd. So we've made a sort of we've taken a big shortcut here, is that none of these shares are encrypted. So in theory, when we blast them onto Nostar, anyone could steal anyone else's secret share if they wanted to. But just to keep things simple, we're not going to do any encryption between our devices for this demo. Maybe this version 2, I think that'll be a nice addition. Cool. So people have already started posting them in. Great. Broadcast mine, 4, 5. Awesome. So we need parties 3 and 7. Great. Awesome. So we've finished we're about to finish the second round of keygen. So let's copy that and go down to keygen finalize and finalize keygen. And you should see key generation complete. And we've got a secret share and a public key. You don't need to copy it to clipboard. I don't know why I put that there. And you should all see the same public key. Do you see the same public key? Good. Fantastic. So that means everything's gone correct. Everyone's acted honestly. We've got the same public key, and you should all have different secret shares that are a part of this Frost key. So we've essentially just done everything we did on paper for a 2 out of 7 using much, much bigger numbers, and we've done it with better security. Except for the encryption part, ignoring the encryption part. All right, so we've got a key now, and we can sign stuff. So Lloyd and Adam, why don't you try and sign something together? Actually, this could get messy. I just realized this is going to get very messy because I didn't separate the sharing of nonces and things between like different room IDs, so they're all just going to flood into this same one. I don't know. I don't know how many will pop up. Like if we keep pasting them in. Session ID, you can make that whatever you want. It just has to be unique to your things. So I'm going to generate a nonce, and going to paste that nonce in. All right, we've already got 2 nonces. So party 1, oh, we've got heaps now. Okay, things may bug out. I don't know. One interesting, with Frost, you can, like if you wanted to sign with more secret shares, all the mathematics works out just fine. Well, how many shares did it copy is the question. All of them? Yeah, I think that's okay. We can just sign with more participants. Does that work in our library? I don't know, really. What do you think? It just has to be consistent with your own laptop. That should be fine. Should be fine. Haven't cleaned that up yet. So the session ID is actually just for yourself, and the session ID is it's used to mix into the randomness when you generate your secret nonce. And then when you're actually going to go to sign, you use that session ID to sort of, oh, which secret nonce did I use for this signing session? Like now that we're going to go sign something, which session ID was that nonce referring to? So yes, this could get messy. So how many nonces do we have here? Okay, everyone's put a nonce in. Cool. So let's sign the same message. We've all got to sign the same message here. This is the important part. Session ID doesn't matter, it just has to be the same as what you put it in before. So I put in Nick, I've got to keep it as Nick. What are we going to sign? What do we want to sign? You already did what? Okay, we're going to do Hello Frost. We may have someone put in you have been pwned. We may have to delete that one, but I think this should all work fine. Okay, so if we copy all, we copy these signature shares. If we delete the one that said something different, the you've been pwned one, I think this should work. If we combine these two, so we did threshold 2, and these 2 parties have signed, so we've got enough signature share, partial signatures to make a signature. Didn't work. Yeah. Uh-huh. Yes. Yes. So what we'll do is, yes, you're right. Yes, you're correct. So what we can do instead is maybe send stuff in other ways, like private messages. Might be, instead of using this buggy web interface. That's true. From an earlier step we could, right? From this step, for the session nonces, we could use less of them. So if you wanna, manually choose some, yeah, we're gonna have to choose. We're gonna have to say who's signing. So let's choose some. I don't think it will reject nonce reuse in this code. So you can reuse nonces if you want to. Go ahead, Lloyd. So who wants to sign? We'll do Lloyd. Lloyd will sign, and who else wants to be a participant? Alex? Cool. So you two. So which indexes were you? Alex is number 4. You're 2. All right. So if we get these ones, 2 and 4, if you guys end up with, if you can clean your nonce stuff to end up with just indices with party index 2 and 4, so just delete some JSON and get it looking like that. Sorry, can you say it again? I don't think you have to edit any fields. I think you just need to delete the extra JSON, the parties that aren't going to be participating, into create signature share. Got that as well, Alex? So you're in create signature share. It should look like this with 2 and 4. Okay, now what are you guys going to sign? You're going to choose something. Hello? Okay, Hello Frost. So leave it as Hello Frost. Exchange it some other way. So yeah, to send it to him over Signal, we're just, yeah, whatever communication works for you guys. Do QR codes. Yeah. It's all secure now, production ready. So while those guys figure out how they're going to do it, I'll just do it on my own in a new session. If you want to run through it on your own laptop, just like you can make multiple tabs to sort of pretend to be multiple parties, that also works. So see what this looks like. So I'll just go, I'll do it 2 out of 2. 2 out of 2. And this tab up here can be party index 1, and this one will be party index 2. And they will both run keygen round 1. And we're just going to start pasting things in. This one has run keygen round 1, broadcast. Cool. And then both participants will go on to do keygen round 2. And keygen round 2. There's a combine down the bottom. Great. Fantastic. Awesome. So you've signed Frost signature. Fantastic. If you want to do something more exciting than just a boring plain message, something you can sign is a Nostr note. I'll just get one up. Sorry, ignore all the stuff on the screen. But making a Nostr event. Oh, I don't know if that's going to work. You could sign a Nostr note and broadcast that, and it should show up on your. I don't think the serialization here isn't right, but if you get the serialization right, if you figure out if you have this hash in hex, if you're able to make a JSON Nostr note, you'll be able to sign that, broadcast it, and it'll show up in your Nostr feed under some burner Frost key that we've just made. Cool. So yeah, if you want to, you can do it in your own browser as well. Like if you open multiple tabs. I think I messed it up somewhere though. Where do we go? Yeah, we'll just keep doing that for a moment. See where I went wrong. Don't know why. Oh, I definitely broke something. So it's tricky to send these messages around. That's why I have these nice hardware wallets where I put them to make all this easy. Which I've lost them. Here they are. Tool that communication nice and easily rather than copy pasting messages, or in some user experiences, as Lloyd mentioned, like there's sort of the first people who put Frost out there have done it all through QR codes. And you can imagine just scanning and scanning and scanning QR codes in the right order of devices. Just the complexity gets really confusing. So doing it over USB is much nicer. So I'm gonna run through one of these really quickly. I'll do a 2 out of 2. Make sure I get it right this time. 2 out of 2, party index 1, and this one 2 out of 2. Party index 2. So the first party contributes their commitments. Second party contributes their commitments. Oh, I know why it didn't work. Sorry, you probably have to use an incognito browser because these two tabs are sharing the same local storage. That's why it suddenly did not work for me. I'm going to start that one again. I should probably not use local storage for this. Should probably do something cleverer. Do 2 out of 2, party index 2. Okay, now this one's going to work. Copy. So first parties contributed their commitments. Second party contributes their commitments. Then we do keygen round 2 for both parties. They exchange their keygen shares. And both parties can finalize their keygen, and they should have the same public key, with which they do, and different secret shares. And so these two secret shares would interpolate to the private key of this public key, which we never knew what that private key was. Using these 2 secret shares, we could figure it out if we wanted to. But yeah, the really special thing about Frost is you never have to actually recombine. You never have to recombine the secret. You can just do all these signing operations, growing the multi-sig, you can do all these things without actually the secret living on any one device. And so now these 2 parties are a part of the same multi-sig. I should really hide these bookmarks. Let's see. There we go, a bit cleaner. So I'm going to sign something. Maybe I should try a Noster note. Maybe too crazy. Oops, I think I skipped a step. I need to generate a nonce. So both parties need to generate a nonce, exchange those nonces. So party 1 has a nonce, party 2 shares a nonce, and then we can start signing stuff. And so you have to make sure you're signing the same message. So we've got a signature share from party 1 and a signature share from party 2. And now we have these signature shares. We can combine them into a Schnorr signature. And we can verify this Schnorr signature on this little verifier down here. So our signature, oh, I didn't copy it all. Copy the nonce as well. And our public key. I did not make these copy-paste friendly. And our message was hello. Let's get it wrong. Let's see, check it actually validates something. So that failed, because I missed the other plus. And hopefully that one verifies. So it's all working. Thank you. Now, last things. What was I going to show you? Do it on paper. There's one thing I was thinking. Oh yeah. So you'll notice we were doing this. We're sharing nonces around. Like every time we want to do a signature, we were like sharing nonces, and then we get all the nonces, and then we sign. But that's 2 rounds, which is really annoying. Like every time when we sign a Bitcoin transaction, we just want to visit our multi-sig hardware wallets. We just want to visit them once. We don't want to have to go, visit A, B, C, and then go get the nonces, and then go visit A, B, C again. That's like 2 rounds, a lot of travel, very annoying. So what we do with Frost is we share these nonces up front. So each participant would generate, say, 50 nonces, and just share 50 nonces to every other participant. And everyone does that. They share their nonces around. And that means we can do 50 signing sessions. We've got 50 nonces ready to go, just waiting for us to do signing sessions. And maybe every time we do a signing session, maybe we replenish that nonce. We just add a new one on. And so we sort of this sort of battery or buffer of nonces that we can just keep signing things with. So that's what in Frost, the R and the O is round optimized. I think that's from the fact that you can pre-share these nonces. I think so. the round optimized in Frost is because of the fact you can pre-share these nonces, right? Yeah. So that the really special thing about Frost and what makes it different to other threshold cryptography schemes is that you can do signing in a single round, which is especially applicable to offline signing devices. Because if they're offline, you don't want to have to do multiple trips of plugging things in and communication. Cool. So we've done all those. If you want to keep experimenting, you can try and sign a Nostr event. It can be done. I've done a bunch of times. It's pretty cool to see your Nostr event just pop up, and you're the only one who knows it was signed under a Frost key. And you can tell everyone it was signed under a Frost key, but there's no way you can really prove it to them. They sort of just, they can't tell. That's one of the special things about Frost is a single public key, single signature. You don't reveal your sort of underlying security setup. Cool. Any questions about Frost, about FrostSnap, about hardware wallets, cryptography stuff? Yeah. Oh yeah, good question. So the reason we have a session ID is actually, it's in our API kind of for these devices. And the reason is we want to, maybe Lloyd could explain it better than I, but we want to be able to like, we derive these nonces deterministically on these devices, and we use that session ID to sort of mix in the randomness and be able to derive that nonce.
No, we don't. We don't
Yes?
do that. There's no session ID. We don't use session IDs.
Why is it in our API?
In what API?
Frost Schnorr Fun.
It's in one of the APIs that we don't use in FrostNap.
Oh, okay.
It's just like a little that's just a random string, like as associated with a particular
message.
Signing session. Yeah, signing session that you can use if you were doing it interactively. So if you're generating nonces up front, online, so we first generate nonces like you're doing and then signing, you can associate it with a session ID to make sure that you, as long as you never reuse the session ID, you never reuse the nonces derived from that. But in general, in practice, you usually avoid session IDs because you can make the mistake of using the same session ID, and then you lose your money. so it's actually it's better in practice to do what we do on the devices, which is just have nonces, and once we create a signature, we delete the nonces before we give away the signature share, and then we can guarantee never ever to reuse the nonces. Yeah. I think the session ID would just mean like it's which nonces you produce. So if you put in the same letters into that session ID field and you generate it again, you'll get the same one. And so what it's like a hack for Nick to get the, to be deterministic. So when you put it into the when you click sign this thing and you put the same text in, it'll get the same nonces. And so it's like a hack to get the demo to work nicely. Otherwise, you'd have to use more local storage.
I think actually what I ended up doing, originally I was doing like that with deterministically deriving it from the session ID. And I was like, I should make this, an actually random nonce. So then I've started using the session IDs like a lookup in local storage, like you say.
Oh, just like a database index.
Yeah, I think I have it. Sorry? I think I've got a whole hour more. So, you got it. all good. I got plenty of time, but probably, I thought you were raising your hand, Shinobi. You got to ask something now. Oh, good. If you guys are interested in purchasing some Frost Snaps, we have I think 15% discount code Taiwan in the promo code on frostsnap.com, and we've got some. We can just hand deliver them to you tomorrow, or later today or tomorrow. And if you decide to do that, you can choose in the country drop down. You can choose local pickups. You don't have to pay for shipping. You don't have to give your address away and phone number and such. Cool. Any other questions or things people want to see? Yep. Good question. Good question. So with the coordinator communicating, I think your question was, can you use that to communicate with different types of hardware? Yes, in theory, but at the moment, we're the only hardware that is doing Frost. So sure, in the future, hopefully we'll have an open standard of how Frost devices should communicate and how they should, share nonces and combine signature shares. What the messaging protocol is, so that you could use, say, the FrostSnap app or Sparrow or some other wallet that supports Frost to do Frost signatures.
Speaking of open standards, how much thought have you guys put into kind of looking at your architectural choices and design choices for FrostSnap and trying to kind of push and inform an open standards discussion around that? Because we saw with the SLIP 39 standard from Trezor for just plain Shamir backup splitting, like they just single-handedly destroyed any shot of that as a backup standard in the space, just kind of YOLOing and not considering the hardware constraints and resources of other devices, so that just kind of torpedoed that. And like, you know, how much thought have you guys put into kind of how you can approach other hardware vendors out there to try to work towards a standard and not kind of have the same kind of fragmentation that led to?
Give that to Lloyd, I think.
Yeah, it's the backup thing is we are very happy with our format. It is one of the difficult things is you need to sort of like have feedback from users, and then by that time it's already too late, right? So you can try and make a technical stand up there, but people like have some technical issue with it, like they think there should be more checksum or whatever. It's like people already have their money on that thing, so you're not changing it at that time. But backups aside, we have been working with the Blockstream research people to work on the chill DKG spec. And yeah, actually quite a few things in chill DKG are from what we wanted them to be there, because we thought like, hey, we need to have this a little bit better. I think we can improve that, and they did some great work and did some cryptography to get what we wanted, and that was really good. Some things we've suggested, and they're like, this is out of scope, and like that's your thing, and you're going to have to go and specify that yourself. Including the backup format. We tried to start a discussion on like how should you back up shares, for example, and then that went to like that's not in the scope of this. They had their own backup ideas but we went with our own thing. So we hopefully we're part of the specification effort as much as we can. We're moving further than it has, because we want like all these nice UX things. Hopefully they'll feed back all the way back into the thing. I think it's hard to get technical feedback since no one else is working on it. Because yeah, we need other people to be really interested in Frost and be putting like staking their future of their companies on Frost. And then we'll definitely be having discussions with those people, but we're the only company doing that, so yeah.
It's funny you mentioned Slip39 actually, is when we were looking at backup formats, I looked pretty hard at whether we could take our Frost, put our Frost backups into Slip39, you know, so we don't have to make our own backup standard, but it was just too big. There was like too much extra stuff in there we just had no use for, and we wanted some extra things that there wasn't room for, so we just had to make something new. Yep.
So earlier in his talk, he mentioned that security of the seed generator is not as important. So I'm trying to understand, like, what are the threat models that I should be worried about? Like, typically for normal hardware wallets, supply chain security is a big thing. So if that's not something that I need to worry about, then what are the...
It's a good question. The approach we're sort of going for is, yeah, your laptop or your phone is able to verify that all the devices are acting honestly. And so, you know, if you're getting your phone, you know, obviously we're not selling you a phone or a laptop, so you get that from somewhere else. Okay, you are still downloading our FrostSnap app. Now, if you are someone who is, you know, wants to be maximally sovereign and, you know, maximally trustless, like you would probably build the app yourself, which is quite relatively simple to do now. So you can build the app yourself, install it on your phone, and that way you've got, you know, you can read the code and you can see that the coordinator is actually checking what the devices are doing, and so that way that security guarantee then sort of passes down onto the devices. So you check by building the code, you're checking that the coordinator is honest, and in its honesty, it is going to check on the devices that they're acting honestly. Other things to think about, don't know. We've been thinking of some, like, you know, the easiest attack is probably someone sends you some Frost hardware wallets that already have a wallet set up on them, or they have, you know, seed phrase backups already written down or something, and they've changed the instructions to say, you know, load this wallet into your phone to begin with FrostSnap. Probably a really high payoff attack. Like, it's been done before with other hardware wallets. It's pretty simple to do. And that one's sort of like an educational challenge as opposed to like a technical one.
But we actually take quite a different approach to security and the threat model. In particular, our product is very concerned with home invasion style attacks, right? Where someone, which is happening more and more often, when someone dresses up as a fake delivery driver or a fake mailman, knocks on the door and then rushes you. And then the crew rushes in and they torture you inside your house or whatever, and they're trying to get you to give up the money, right? So we actually don't use pins or passwords in any part of the app. Like the security access is only via getting multiple devices. There's not like if you're inheriting money, your children, your wife, or whatever, they find enough devices, they get the money. There's nothing they need to remember. And it's same with an attacker who's coming in. So the problem when I've been studying these attacks is with pins, and especially decoy things, is the pins just mean you're going to get tortured to give the pin over. The second problem with the decoy ones is there was like a case where some attackers, they thought the guy had hundreds of Bitcoin, so 200 Bitcoin. They said, give us 200 Bitcoin in his house with his family there. And he actually only had 20 Bitcoin. And they got his 20 Bitcoin pretty early on in the process, but they were thinking like, this is the decoy wallet. There may be another wallet, and he ended up, his daughter, his wife, and himself being tortured for 13 hours before they finally gave up to get, the money that didn't exist. So we don't use deception in other ways. So when you're coming in and you attack someone who has a frost snap in their house, it's very easy to show like what the devices are called. They each have a name, right? And we can say like, we need to go to this other location. There's no passwords, there's no deception, there's nothing you can extract out of me. The security is just where the physical devices are. And that's 100% the game. So it's up to you to put those devices in a place that scenario is not going to pay out for them. And so that's the biggest difference in our security approach to anyone else's approach, yeah.
And that also flows down into inheritance as well. So by not having pins on the devices, it's very easy for your loved ones to just, assemble, bring them all together, restore the wallet on a new phone, and then they've got access to the funds straight away, not having to, follow some crazy treasure trail of BIP39 passphrases and derivation paths and XPubs. It's just nice and simple. You have the devices or you have backups, and you can access the funds. Cool. Any other questions or demos you'd like to see of like frost snap things? Can show you Alex or.
I want to see somebody make a one of n shit posting account on Nostr so nobody can claim they didn't post anything.
Funny you bring that up. So it's interesting with Frost. Like if you do a one of n, the mathematics falls back to just everyone knowing the same private key. It's like this. You don't even need to do Frost, right? It's like you can do it.
Copy paste.
Yeah, so you can go. I mean, the only interesting thing about doing a one of n maybe is that every device is contributing entropy to that overall private key, but everyone knows it at the end. But at least it's random. So yeah.
I know Frost supports changing out the signer set. Does your device do that?
Not yet. So yeah, with Frost. Because it's just these nice shares on a polynomial, you can do fun things like evaluate that polynomial at a new index and enroll a new person into that multi-sig. So you can go from a 2 of 3 to a 2 out of 4. And then there's more exotic mathematics you can use to rotate that polynomial, sort of shift onto a new one and get shares that it still interpolates the same group wallet, the same group private key, but everyone gets new shares. So that's potentially useful. Say one device gets compromised, someone steals my device, I've got my other two, they could rotate to new secret shares that are incompatible with that one that got stolen. So if an attacker stole another device, it's not going to be of any use to them.
Yeah, I'm curious how you'd think about the the UX of that. Like what do you do if the old device comes back online? Like what do you tell that device? Like when you detect that it's moved away and stuff like that. So.
Yeah, that's tricky. Haven't got to
One of the main reasons we haven't done it is because of all the UX design work that goes into these things. We actually like to tell an interesting story. We used to have the devices, they used to be able to handle multiple keys, right? You can generate as many wallets as you want on the devices, and it was too difficult to explain that situation in the UI. Like you have a device which maybe has 2 shares in the same wallet. So it has more voting power than the other devices. It's like, how do you select which devices you're going to use when different, you have to like add up to a certain amount of points or whatever. And so we just said, each device has 1 share. And that is it. And 1 backup. And that is it. And so, yeah, 90% of the work is not the maths or the cryptography and the security proofs. I mean, that's hard stuff and it's very specialized stuff. But the stuff that's really hard is figuring out where to put the buttons and what to put the numbers in. Yeah.
There's some other stuff we would love to get to in the next year or so. So yeah, one related to that is like an inheritance pathway that's a separate multi-sig that accesses the same private key, same wallet, and that can be completely separate to your everyday multi-sig. It can be different threshold, whatever makes sense for you. And then there's other sort of convenience things we would like to have. So yeah, multi-sig is like inconvenient by design. It's meant to be hard to spend your life savings. You shouldn't be able to spend your life savings in just a single sig in a few minutes. But it's also kind of annoying. Like if you want to actually use that hardware wallet, you don't want to have to go visit these devices every time you want to buy something at a Bitcoin conference. So we'd really love to be able to say spend up to 1 million sats per day just using one device. And then if you want to spend over that limit, you have to visit, say, 2 out of the 3. And we also do that using a separate access structure. It'll be a 2 out of 2 with the phone and the device. So yeah, each device and the phone has its own 2 of 2. And the spending policies are then enforced by the phone or the device, hopefully both when we implement it.
So I know you guys are a hardware company, but have you ever thought about applying it for like Frost to like Lightning nodes? Because like one of the biggest security flaws of like Froster for Lightning, right?
Yeah, I think Lloyd's looked at it more than me.
Yeah, there's been some talks about how to do this. There is some just like theoretical issues with doing it. You can do it fine with especially what you would call in a BFT or Byzantine fault tolerant design where you have like a super honest majority, like a 3 out of 4. In those settings it gets easy. People don't usually realize that. So if you've got like a Lightning farm and like different servers and you're willing to do like a 3 out of 4 or like a 5 out of 7, so that there's like there's a guaranteed honest majority, so 2/3 honest majority. The maths and everything works out quite easily. The difficulty you will always have with this kind of thing is that if you have less than that, you can have this like imagine just a 2 out of 3. So one of the guys is malicious then, right? Because you're able to tolerate only one malicious actor. The first malicious actor goes to like one guy and says like, with Lightning, you can lose all your money with revocation, right? So if you sign something out of order or something that is, use the same revocation key, is it? Anyway, there's a revocation thing, right? So we go and I revoke that previous state with one guy, and then I'm malicious and I go to the other guy. He doesn't know we've done that revocation, and now I go and do it with the other guy, and that's still a 2 out of 3, but I hide the state from another guy. And so that's why you kind of need a consensus algorithm to come to consensus about what we have signed and what we have not signed. Well then, yeah, but like that's the issue is like that malicious server then starts to do that protocol, right? So it's like, yeah, Yeah, exactly. Yeah, so exactly. So you have to be very careful. And the reason people have not done it so much is because they haven't been focusing on maybe like personal and like eking out every advantage you can get in personal security. Because yeah, there's like just to physically separate out the Bitcoin, the keys that owns the Bitcoin step. And that one you can do. It's just about the live signing of states. And people have been mostly looking at it from a hosting situation, right? Yeah.
Yeah, interesting question. We've also looked at like doing, not doing just hardware, and not needing hardware to do Frost. So like maybe in the future, you'll just be able to have the FrostSnap app on a few mobile phones and be able to make a Frost multi-sig with that. But don't know what the user experience will be like for that yet. Yeah. Any other questions? Might wrap it up. Final chance. Awesome. All right. Thanks very much, everyone. Thank you.
Thank you for being here. My name's Alex. I'm here to talk to you about building sovereign banks with Fedimint. Okay, so as Bitcoiners, typically, we love banks. But just kidding, we hate banks. Banks used to be great then everything changed when the surveillance state attacked. Yeah, I'm here to make an argument that the core of banking is actually a very fundamental, amazing innovation in personal finance that we can make great by solving the problems of. So, overview of today, some background. We're going to talk about how banks went wrong. We're going to talk about the innovation of eCash. What is eCash? We're going to talk about Fedimint. And then if there's time, we're going to have about a 20-minute workshop that's speed-runned. Yeah, you guys aren't going to have time to follow along, but hopefully I'll be able to show you how to build a wallet from start to finish in like roughly 20 minutes. Cool. So, part 0, pre-cash and banks. We're going to talk about gold and banknotes and pre-digital banks. First, the OG of money. So what was money back in the day? Well, we used gold. Gold was an incredible innovation and because of its money properties. Gold has all of the great properties that we care about when using a good money, and it's been the GOAT for 9,000 years. Since Mesopotamia, we've been using gold for money. So how did a payment work in a gold money world? Well, a payment's pretty simple. If Alice wants to pay Bob, Alice pays Bob a pound of gold, and then the payment is settled. But this has some obvious problems. This is not a very safe transaction. If you're carrying around bars of gold to pay people, you can get whacked and your gold can get stolen. And also, it's really heavy. It's really inconvenient to carry around your gold, obviously. So we have to come up with a better solution. So how can we protect our gold? What was the first innovation? Well, the first innovation was banks. We have banks, and how this works is that the users would deposit their gold into a bank, and the bank will invest in security once for everybody. And then you can settle payments out of band without having to go to the bank every time. So yeah, banks protect the gold, they invest in security once, and you can make payments without physically moving your gold. And this is cool. So how does a payment work in a bank and notes kind of world? Well, first, Alice is going to deposit 1 pound of gold into the bank. Then the bank is going to respond by giving Alice a note that's worth that 1 pound of gold, a voucher for that 1 pound of gold. Then if Alice wants to make a payment to Bob, she's going to hand Bob the voucher. And this is effectively changing the custody of that gold from Alice to Bob. So now Bob can control that gold, and if Bob wants to withdraw the gold from the bank, he can go back to the bank and he can get the pound of gold. Pretty straightforward, pretty standard. This is super cool. We get some awesome properties with our bank just in this very primitive, archaic system. We have reduced friction in our payments. We actually have really good privacy in our payments because you could pay somebody out of band outside of that bank a bunch of different times, and only the final person that's withdrawing from the bank reveals their identity to the bank. So we have some amazing payment properties already. And lastly, for the users, it's much easier to protect the banknote than it is to protect the gold itself. You can hide it, you can conceal it, it's light, it's portable. So yeah, we have a much better payment system. So we fixed the money, right? We have no more problems. We no longer have to innovate. Well, of course, we have a couple of other things to overcome. First is globalization, and second is the internet with digital payments. There is a logistical component to paying people around the world that banknotes are not good enough for. And yeah, with the internet, you can't just send these papers over the internet. So what do? So we entered the digital world with banks. We need digital payments. How is this going to work in a digital-first world? So,
thank you. Wait, am I speaking in this or this? Seems like I have a mic already. Great. So good morning, everybody. My name is Calson. I'm a Taiwanese American, but I've been back and forth between Taiwan and the U.S. My entire life. Just a little bit about myself. I studied computer science and electrical engineering. I actually started my career here in Taiwan as an RF engineer. But, you know, and I worked on consumer electronic devices like network. Thank you. Wait, am I speaking in this or this? Seems like